everyone. Just a real quick announcement before you get started with your lecture. Being that you're second year, a lot of you may be familiar with this or heard it a few times, even yesterday, so sorry if you have to hear it again. If not, my name is Doreen, this is Jessica. With the special events program, we try to find just fun things for us to do as students when we're not inside the classroom studying and worrying. But anyway, we got in some student passes. This semester they gave us a chance to go see a live comedy show. If you're stressed out at all, you like to laugh or need to. By a show of hands, does everyone here like comedy? Yes, yes, yes. Oh, all right. Because this year they gave us passes for Dangerfields. If you're not familiar with it, it's right on 61st and 1st. And they gave it to us for 80% off the normal price that they charge the general public. So if you've been there before, you know it's New York. It's pretty expensive. They charge the general public $25 per person just to get in for admission. There's always that standard 2-item minimum, so you have to get something while you're sitting there. We get the student pass for $10, and that $10 pass admits 2 people in. So it breaks down to us paying $5 a person for a 2-hour show. The key thing with these, the reason why we get the tickets for Dangerfield is because they do not restrict us on any other shows. That means they're valid even for special events and holidays, weekends, holidays, doesn't matter, for the next 2 years. So it expires in December 2010. So they're doing the announcements until they run out, but if you'd like to get them, again, they are the $10 each. Each one admits 2 people. And although you have to be an NYU student to get them, you don't have to be one to use it. So you could take a date, somebody who doesn't go to school here, or use it as a gift idea, which a lot of professors do. And the point is just to have some fun and save some money while we're in school. So by a show of hands, is there anyone here who'd like to go? Just raise your hand. Yes, 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 and that's it. Thank you.
Not during class. You can leave it in the back and people know.
Okay.
Thank you. So you guys found your lease commitments yet? You have no idea what I'm talking about, do you? Okay. So you remember last session we were talking about leases, right? Converting leases to debt, and I took the gap example, and let me very quickly go through that last slide because I might have missed you. Basically what I did was I took the lease commitments that the gap gave in that 10K and converted it into debt. It's not rocket science. I just took the lease commitment each year, discounted it back to today using the pre-tax cost of debt. Remind me again, why the pre-tax cost of debt? Why not the after-tax cost? Yes? No, that's not what I said. It's no. Let's not even go whack the whole thing. There's a very simple explanation. What are we discounting? Pre-tax lease commitments. The commitments are giving you a pre-tax numbers. And we're treating them as debt. So the reason we use pre-tax is because the cash flows are pre-tax. And we use the cost of debt because we're treating the commitments as debt payments. We're being internally consistent. So we take the lease commitments, discount them back today. What we get as a present value, $4.4 billion, is the debt value of operating leases. Now, for those of you doing U.S. companies, this should be trivial. Trivial in the sense every U.S. company is required to reveal its lease commitments over time. Some might be a little tricky. They might have a year 4 and then beyond. That's not a big deal. You just have to spread it out. If you're doing non-U.S. companies, increasingly this is available in annual reports. When you look at the annual report, you'll find it. For some non-U.S. companies, there are lease commitments, but they don't tell you what they are. So what are you going to do with those companies? So you see what I'm saying? You have a European retailer. You know they lease their store spaces. You know they spend a ton of money on it. But they're not telling you what the commitments are. What are you going to do? This is one thing I don't want you to do, okay? Because this is actually something you're going to be faced with a lot of information. If you don't have it, ignoring it seems to be, ignoring it is an assumption, right? When you ignore it, what are you assuming the lease commitments are every year for the next 5 years? 0, right? So when you ignore something, don't act like you're not making an assumption. Be honest with yourself. Ignoring something is making assumptions. So the question you got to ask yourself is, assuming it's 0 every year for the next 5 years and beyond, the most reasonable assumption. Now let me rephrase the question again. You have a European retail firm. You know that they have lots of lease spaces. You know they have lease commitments, but they're not telling you what those commitments are. What are you going to do about them? Ignore, as I said, ignoring is off the table now, so you got to ignore them. Yeah. Comparables, the problem is scaling is going to be difficult, right? But they're all European comparables, so none of them might give you the information. Yeah. Do you know what the lease payment was last year? That's usually broken out, rental expense. So they'll give you the expense last year. What they haven't given you is what those commitments are into the future, right? So assuming there's 0 might be unreasonable. But if you know what the lease payment was last year, let's say it was $500 million. You could make an assumption saying it's $500 million every year for the next 7 years. But that's an assumption. It's a more defensible assumption than assuming it's nothing for the next 7 years, right? So if you have a company that you know has lots of rental and lease expenses, even though the commitments might not be given, you might have to make up some numbers, but base it on last year's number and make it into a commitment 7, 8, 9 years. That's typical for a retail firm, and see what you get. Right? So what you get at the end will be the present value of leases. This is now going to show up on your balance sheet as debt, $4.4 billion. Now, of course, when you create something as debt on a balance sheet, you've got to have a counter asset, otherwise the balance sheet will not balance. So now you have an asset worth $4.4 billion. What shall we call it? Let's call it the lease stores, because that's what it is. What I want to do now is actually take that and look at the consequences for operating income and everything else we do in valuation. As I said, once you convert leases to debt, you cannot leave the operating income untouched. You see why? Because the operating income that the GAAP reports is after lease expenses, and we've just said it's not an operating expense, it's a financial expense. So here's the full adjustment. You could take the stated operating income, which in the case of the GAAP is $1.012 billion, add back the lease expense, saying, hey, you should never have subtracted out. It was not an operating expense, it's a financial expense. What's this last item? $4.4 billion divided by 7. That's actually, remember the leased asset, $4.4 billion? This is one of the pains in accounting, is you create an asset, you've got to depreciate it. You're saying, why are you using straight line? You want to use sum of the year digits? Be my guest. Double declining? Go ahead. Life is loaded up as it is. Why are you making your life even more messy by going out and making depreciation method assumptions? So you know what I've done is I've taken the $4.4 billion. I've used straight line depreciation. Do you see why I used 7 years? Because that's what my lease expenses ran through. In a sense, I've matched up the asset life. So in a sense, let the lease tell you what life to use. Stick with straight line depreciation, which means my adjusted operating income for the GAAP is going to be about $350 million higher than they claimed it was, of $1.362 billion. I also told you there was a shortcut that I sometimes use. Here's the shortcut. Take the stated operating income, add to it the $4.4 billion times the pre-tax cost of debt. You see what that would have been your interest expense. If this had really been treated as debt, that would have been the interest expense this year. You're saying, why am I adding it back? What's operating income? What's the accounting term? Earnings before interest and taxes. If this had been an interest expense, the earnings would have to be stated before the interest expense. I'm adding back the interest expense to come up with the adjusted operating income. I actually did this at the GAAP in 2004. And as I went through each layer of what would happen to their numbers, initially they were in a state of delirium. I mean, it seemed like everything was going their way until I hit them with the final step. Okay? So I'm going to take you through the adjustments I made. You can see why they were happy up to a point, and then kind of things fell apart. So I said, this is what I'm going to do. I'm going to take your numbers that you gave me in your accounting statements. I'm going to redo those numbers assuming leases are debt. Let's see what happens. Okay? Let's start at the top. They told me their operating income was $1.012 billion. I said, you know what? You guys did a lot better than you told me. This is the first stage of delirium kicking in. Oh, this is good, this is good. Income went up from 1.012 to 1.362 billion. Higher earnings is better than lower earnings, right? Then I said, it's not just that. On your balance sheet, you did tell me you're only 1.97 billion debt. You really have 6.4 billion. This made them mildly nervous that they were showing more debt. But I said, but this is a good thing. You know why? Because when I do your cost of capital is a weighted average of your cost of equity and cost of debt. If I stuck with your conventional definition of debt, you'd have less debt and more equity, and your cost of capital would be 7.3%. But if I adjust that debt for leases, you have more debt, higher debt ratio, your cost of capital actually goes down. Everything. Even with the higher beta. Remember though, when you talk about leveraging the beta, what are you levering? Describe the process of what you're levering. How did you get the bottom up beta? Did you do leases for all the other companies? No, but remember again, it's not that easy, right? Do you see the point though? Because when you talk about levering and unlevering betas, you start with a bottom up beta. If your bottom up beta was computed with leases treated as debt for every firm, then when you lever up, it's going to make a difference. But if your firms are all retail firms, they all have leases, and you're treating all of them as not debt when you do the beta. Exactly. You've got to be consistent. If your bottom-up beta was computed without leases, you cannot at this stage count leases just for this firm, because that's not fair, right? So if you do a bottom-up beta with leases treated as debt across the board for every retail firm, then when you lever it up, it's going to end up at pretty much where it was, because your leases are a big component for every company. The unlevered beta is going to be much lower. The levered beta is not going to be that high. So at this stage, you can see why the GAAP thought everything was going in their favor, right? Higher earnings, lower cost of capital. So here's where the other shoe drops. One key number, this is a number we're going to return to again and again in valuation. A key number that drives the value of your company is what kind of returns you make on your investments, the return on capital, return on equity. Those are the only numbers that are accounting numbers, right? Because you take the earnings and you divide by book equity, book capital. With the conventional definition of return on capital, I took their stated operating income, I took their stated book debt, and I came up with the return on capital for the GAAP of 12.9%. But I said, you know what? I don't believe that. Because your biggest debt is off the books. Your true return on capital here has a higher operating income, so that's a good thing. But in the denominator, when I compute the debt, I'm going to include the leases as debt. The return on capital goes from 12.9% down to 9.3%. So two things work in your favor, one worked against you, right? The two things working in your favor, you have higher earnings, lower cost of capital. The one thing that's working against you is you have a lower return on capital. Two are going to push up your value, one is going to push down your value. So you know the question they asked me at the end was, well, after you do all of this, will my value per share go down or go up because of this adjustment? What's the answer to that? Is there a clue in these numbers that will tell you whether the net effect of converting leases to debt is going to be a good thing for the GAAP or a bad thing for the GAAP? Yeah, because it seems like on the one hand and the other hand stuff, right? But there is a number here that you can look at that will give you a very quick indicator as to whether the GAAP is going to come out of the process looking better or worse. Yeah. Well, the WACC has, in fact, gone down.
So you're going to discount at a lower rate, which is going to push up your value of your firm, which ultimately is going to...
But where does the lower return on capital play in here? What does it mean when you have a lower return on capital? When you grow, you're making less value on your growth, right? You're taking poorer projects. It's true you're discounting your cash flows at a lower rate, but you're also passing judgment on the quality of these projects, that the GAAP, in fact, does not have as high a quality projects as you thought it did before you made the adjustment. So one is the cost of capital is going down, but the return on capital is also going down. Therein actually is the clue. Can I combine those numbers to create some composite number that brings both in? What if I took the difference between the return on capital and the cost of capital? What do we call that? That's really your excess return. What are you making over and above your cost of capital? Before I make the adjustment, look at the difference. 12.9 minus 7.31%. Looking at the company, I thought they were making 5.6% more than their cost of capital. Once I make the adjustment, 9.3 minus 6.25, I'm learning they're making only 3% above their cost of capital. I'm going to go out on a limb. If I value this company using the old numbers and the new numbers, I will predict that the value per share for the GAAP is going to drop by about 15 to 20% because of this capitalization. And the reason it's going to drop is because the excess returns that I see them making in the future are far lower than I thought they were. In fact, I'll give you the most disastrous scenario for you as a retail firm. If a retail firm that looks good in terms of making more than its cost of capital before the adjustment, you make the adjustment and the numbers flip. Numbers flip in the sense your return on capital actually drops below your cost of capital after you converted leases to debt. That's the kind of firm where you thought you had a good firm until you made the adjustment. Then you realize this firm's a disaster. Want an example for this? It's right across the street. Who am I talking about? Starbucks. A firm that has been on a pathway to disaster for 10 years, but for 9 of these 10 years, equity research analysts thought they were a great company. Why? Because they were looking at the surface numbers, return on capital, cost of capital. And here you have Starbucks. If you think about the lease, they have about 170 Starbucks stores just in New York. You look at the lease commitments they've entered into. You convert the leases to debt. They have actually earned less than their cost of capital now for about 4 or 5 years. But he said it didn't catch up with them. It didn't catch up with them until last year. Eventually, the truth gets out. Surface level numbers can get you only so far. And here, because they've consistently grown and they keep adding new investments, earning less than the cost of capital, they're actually destroying value as they're growing, not adding value. And that's the main reason I think why we need to capitalize leases. Yes? Well, if you have bonuses, you probably can net out the commitments in that year against the bonuses that year. So unless it's some disproportionately large year, the net amount that they report should be net of those bonuses. Okay? So I'm not sure about the complete accounting for it, but when you see the lease payment there, it should be net of whatever pluses they got that year against those leases. So, but these are net lease commitments, so what's left is what you're reporting. Okay? So any questions about this? So the reason we capitalize leases is to get a better sense of the quality of the projects. Yeah. Right. Okay. Capital leases, how do they in fact capitalize leases? Those capital leases, what do? They do exactly what we do here. They've already done them for you. So capital leases are not a problem. They're treated as debt already. The income is already adjusted for them. It's only operating lease payments. Only operating lease payments. You cannot capitalize and show it as an operating expense. So the only leases we really have to worry about are operating leases. Capital leases are already taken care of. Outside the U.S., everything is operating leases. There are no capital leases at all. Everything will be treated this way. We have to do the conversion. Yes, Luis?
In the case of Starbucks, any company that is closing a store, can it be the case that future commitments are not used? So it's not kind of debt because you're not going to really pay them, and then your revenue.
Well, that's like that. Can't you always sell an asset and pay off debt? Let's say you took conventional bank loan. You have a building. You can sell. I mean, so the fact that you can close a store and retire the debt doesn't mean it's not debt, right? So it's true you might have a little more flexibility with leases than with conventional debt, which actually can translate into a higher cost of debt. So in a sense, we're actually giving them an advantage by giving them the same pre-tax cost of debt. So I don't think that's a reason against using it as debt. You're saying it's more flexible as opposed to less flexible debt. That might be fine, yeah? Yeah. That's lease income. That's the other side of the transaction. They have to, the accounting there is pretty clean. They have to record the income. That's a different issue, right? Yes, Malik.
So it's the idea that you're adjusting operating income and you're also adjusting the WACC. That's how the ROC and the WACC.
Exactly. You're adjusting your operating income. You're adjusting the capital invested. You're adjusting everything changes, right? The excess return changes, right? So it's not just one item. And a lot of people, when they make adjustments, analysts, when they make adjustments, often adjust 2 out of the 3, which often can mean you help a firm by converting leases to debt because you're not taking it all the way to the end. Right? Everything has to change. You capitalize leases. It's not just the income. Everything, book equity, book debt, everything changes as a consequence. Anthony?
Last year we also did synthetic ratings, but I don't remember if it was in the context of leases. How could
You need that as a precursor to doing the leases because you need a pre-tax cost of debt.
once you have that value of debt,
Right.
and then recalculate the cost of debt?
If you want to go back and redo your synthetic rating, you can. In fact, all my rating spreadsheets do that. There's circular reasoning built in because when you enter leases, I go back and redo your synthetic rating with the leases treated as debt. Because you're right, there is a circularity here, right? Because until I brought in the leases, you might have thought you were a AAA rated company. Now that I brought in, oh my God, I'm a BBB rated company. So that's why all those rating spreadsheets take the lease commitments and try to build them in to come up with a synthetic rating that is reflective of the leases, because you want it to be, right? As a lender, you know they have big lease payments. You're going to build it into your cost of debt. Yes? They do factor them in. How they factor them in is kind of messy, but they do factor in the lease payments when they do the ratings. You look at retail firms, they clearly are reflective of the ratings. Whether they reflect them correctly or not is a different issue, but that could be asked of any rating, right? But they do try to bring them in. Any other questions? Now, is it just leases, or what is it about lease commitments that make them like that? It's not just that they're operating expense, but these commitments are kind of rigid commitments, right? They're not conditional on whether the store does well or not. You've entered into a commitment. So do you see what I'm saying? I'm opening a door here that might not be easily shut. Any commitment you enter into as a company that is a fixed commitment that's not conditional on performance is like lease commitments, right? I was just valuing Under Armour. Right? Under Armour, for those of you who produce that, they have sponsorship commitments because, as you know, Under Armour is a big sponsor of sports events like the X Games and stuff. So you look at their footnotes, they reveal lease commitments, and right next to it they have sponsorship commitments, which are actually 5 times larger than their lease commitments because that's their big commitment. I'm going to treat that like that because they could back out of the commitment, right? But the only conditions under which an Under Armour can back out of a commitment like that is if it's like GM. It's still a NASCAR sponsor. Shows you how difficult it is to back out of a commitment like this. GM, a company that's on the verge of bankruptcy, what the heck are they doing sponsoring NASCAR? But once you sponsor, once you get that commitment, it becomes a fixed commitment. So if I were in the valuation of Under Armour that I have on my website that I'll put up a link to it, I've treated the sponsorship commitments like that. Changes my view of return on capital, changes my operating income, changes my book debt number. But I think that's the right thing to do. Any Yankee fans here? No? No Yankee fans in this whole room? April 16th is opening day. If you can spend the $300 on StubHub to sit in the bleachers for that day, go. And view it as a valuation exercise. Here's what I want you to do. Top of the first, I want you to look across the infield at the Yankee infield. Okay, help me out. Who's at first? Teixeira. What's the contract? $180 million over 7 years. Fixed commitment? There's no escape hatch out there. The Yankees can't say, well, we're not playing well this year. Fans didn't come in. $180 million over 7 years. Let's move over. Second base, Robinson Cano. Smaller commitment. What is it? $5 million over 6 years or something. So that's a nice, but still a fixed commitment. Jeter, down to the last 2 years of his contract, right? $17 million a year for the next 2 years. And then you go all the way across to Steroid Man. Eh? I like A-Rod, but this is going to be a very interesting season. What's his contract again? 9 years left of $27 million a year. And who's pitching opening day? CC Sabathia. $150 million over 6 years. And who's behind the plate? Posada, 4 more years left at $14 million a year. Hey, this is a lot of commitments you've added up just in the infield. Forget about the outfield. There are the equity positions. Here's the fixed income right there, right? You asked me to value the Yankees. I'm going to take the present value of those commitments and treat them as debt. And this is not just the Yankees. A lot of professional sports teams are a lot more levered than you think. Because if you look at the balance sheet, all you see is conventional debt. But these superstars have 8-year, 10-year, 12-year contracts with no escape hatches. Remember 4 years ago when Giambi had those issues? And they tried to send him back down and he said, I won't go. And they looked at the contract and they had no clause. Basically, they had to pay him $14 million whether he sat on the bench or played on the field. That's a fixed commitment. So in a sense, we've got to expand our definition of debt to bring those in, because if we don't, we're going to get into trouble, because you let the Yankees borrow conventional debt on top of these contracts, you're going to have what happened to the Pittsburgh Penguins. The Pittsburgh Penguins went bankrupt, and you could not play Mario Lemieux. He actually ended up with 30% of the team because they could not pay his contract. You have to be careful about fixed commitments because they carry the characteristics of debt, have to be treated as such. Okay? Somebody back there had a question? Yes? They have to trade him with the contract. You know, with the big contracts, when you trade the player, let's suppose he's hopeless now. Right? If you trade A-Rod and let's say he blows out his knee, you usually will have to pay the rest. It's not like you get out of the contract. The other team will take him, but you will still be paying $27 million a year. No, even if you trade him, the other team has to agree to taking the contract. In these big contracts, you actually end up with a contract even though you've traded the guy. It's happened lots of times in baseball, where a big star, especially on the downside, gets traded, but the team continues to pay. Like what did the Texas Rangers end up paying on the old contract, even though they traded A-Rod to the Yankees? I think they ended up paying, what, 8 to 10 million of that contract for 4 years after he left Texas. So it's very difficult once you sign this contract. If Scott Boras is your agent, I guarantee you're going to get paid $27 million a year every year for the next 10 years once that contract is signed. He will find a way to get it delivered. It's amazing how few escape. It surprises me because I would try to build in some escape hatches but the way it's written is it's almost amazing how inflexible these contracts are. Okay? Yes? Right. Everything's going to change. Income's going to change. Book. Oh, I'm not going to go back and check against your 10K. That's not. I mean, in a sense, if you're asking, am I going to check your numbers? But that's not my job. I will assume that you start with the 10K. You did whatever you need to do. I will look at your valuation and tell you whether the numbers are internally consistent. There is no way with 160 people I'm going to be checking the numbers. But for your own sake, keep track as you go through. Start with the basic 10K, and as you make transitions, check your transitions as you go along, right? Because you need to be clear with yourself what you've done with these numbers, because by the time you get to the third round, the numbers are going to bear no resemblance to numbers you start. You can't go back and check against the 10K anymore, right? But you need to know that the links have been made correctly. So I don't think I can check that for you, so I will leave that to you. Here's the consolation. If you use any of my spreadsheets, it does it internally within the spreadsheet. You'll actually enter the 10K numbers. The spreadsheets are built in. And part of the reason I built them in is I wanted them all in one place. So I was not building 7 spreadsheets where I had to keep checking them back. They're all built in as worksheets, and you can see the linkages across. You can actually turn them off and on. You can say, no, say do you have operating lease? If you turn it to no, it'll revert back to the 10K number. So you can see what the numbers look like before you make the adjustment. Yes, Louis?
Present value of stock options or any professional firm.
Stock options are not fixed payments, though, right? Stock options are a function of the stock price. See, the essence here is not that you're going to be making 15 shares every year, but that the 15 shares come at a fixed price. So here, I think the problem is you're agreeing to a fixed amount each year. That's the nature of debt. And that fixed amount is not conditional on performance, whereas stock options are conditional on performance, right? If the stock does badly, your stock options go to 0 in value. So stock options have a different set of problems, but they're not these problems. Yes? Pension can be. In fact, the more rigid the pension laws become, the more you have to start treating them as debt. What right now U.S. companies have a lot of flexibility with pension, underfunded pension obligations. They have to show them as a commitment. But there's no legal requirement that they have to set aside 10% of that commitment every year. If that were a requirement, then I'd start treating them as debt. Okay? Right now, that's not true yet. No, they're not commitments. All you have to show right now is the underfunding. That's just for informational purposes. So GM can say we're $25 billion underfunded, but there's no teeth beyond that. It's not like they have to set aside $5 billion every year. That's between them and their union. They might have to negotiate what they have to do. But right now, it's a pretty flexible, process of meeting that gap. Yes.
How do you discount the cash flows on the other side of the cost? Because I've been asked everybody to be money from General Motors. So you're going to use like the cost of capital of General Motors or
You tell me. Where's the risk here?
General Motors.
No, you answered the question then. Right? The discount rate you use to discount cash flow should reflect the risk of those cash flows, which means you've got to trace back where does the risk come from. And the risk comes from GM. That's really the cost of debt you should be using. Okay? Yes? That I think is different. Purchase commitments are a function of operations. If you don't operate, you don't have to do the commitment. So that's very different. I would not treat those as the equivalent of sponsorship commitments, for instance. So you don't want to expand this too widely, right? So No, because they've been growing, right? It's been increasing because the revenues have quadrupled over the last 10 years. So that doesn't surprise me that it's increasing, but you'll also notice that if the revenues start dropping off, those commitments very quickly drop off as well. Well, that we can come to later. It's got to show up. I mean, I don't even know whether you need to treat it, right? If all you have is a commitment, you're not setting aside the money for it, why should it even matter here, right? You've just agreed to buy from a particular supplier, you're revealing it in the financials. I'm not even sure it affects much after that. It should show up in your operating expenses already from previous commitments. You've already built it in. There's nothing extra you would need to do there, I think. Yes? That is, it depends on how rigid those contracts are. In the U.S., I would never would. There's no union labor contract that you'll be required to if you're on the verge of bankruptcy, right? I mean, in Europe, it might be different. If you're in a very rigid labor law, it might become the equivalent of debt, which will then be a cautionary note. Don't go out and borrow money if you have this union labor contract that requires you to make $150 million in wage payments in good times and in bad times, right? So it's more, I think, a shot across the bow across companies saying don't get, lulled into a false sense of complacency because of the conventional definition of debt. Think about these commitments because they do affect your leverage as a company. Right? Yes?
How do you treat interest rate swaps?
They do nothing. I mean, I'll tell you something. Securitization and swaps cannot change your value as a company, right? Because all you're doing is it's a fair market value swap. The only the way a swap could affect your value as a company is by altering your term structure of debt, the kind of debt you have. It might make you better matched, which can then lower your default risk as a company. But that's the only way swaps or securitization can affect value, because otherwise you're replacing $1 billion of long-term debt with $1 billion of short-term debt. $1 billion of dollar debt with $1 billion of euro debt. There should be a zero effect on your value from swaps and securitization. Okay. Any other questions? Okay. So this is the lease story. And kind of think of it as a broader issue. It's not just lease commitments, though it's the most obvious place to go. It's any kind of fixed commitment you have to make in good times and in bad times. Here's the other issue, R&D. Clearly, how big an issue this is will depend on what kind of company you value. And just to give you a sense of what kinds of companies are going to be an issue in, computers, obviously big issue, R&D. Pharmaceuticals, I should have put that in there, big issue. Petroleum. What R&D is there in petroleum? What am I talking about? It's because accountants do with exploration expenses exactly what they do with R&D, which is treated as an operating expense. Again, think of why we're doing this. We're saying this is expenditure you're incurring to create future growth, right? I shouldn't be charging this expense against current revenues. I should be treating it as CapEx. So here's the process by which I would capitalize R&D. First question I'm going to ask you is, on average, how long does it take between the time you do R&D and a commercial product emerges from the R&D? Do you see why I threw the on average up front? Does all R&D pay off? No, some it's not going to pay off. Some might pay off in 3, some might pay off in 7, some might pay off in 10. So on average, how long does it? I call this the amortizable life for R&D. Basically, I'm trying to figure out how long is there, what's the lag between R&D and commercial product? So let's take a couple of businesses, and you tell me what type of lag you'd expect. Pharmaceutical business. 10 years, if you're lucky. Think of the 3-stage FDA approval process. At least in the US, R&D in the pharmaceutical business could have 10, 12, 14 years. In contrast, if you look at a company like Microsoft, R&D should have a much quicker payoff, right? Because you might have 2, 3, 4 years, because you're not going to wait 10 years for that. So that's the first step. Based on the business you're in, give me an amortizable life. Okay? Make a judgment. Okay? Is it short? Is it long? Because that's going to drive how you capitalize R&D. Once you've given me that amortizable life for R&D, I'm going to go back in time and I'm going to collect R&D expenses every year for the last 5 years, the last 10 years, depending on your life. So if you give me a 5-year life, I'm going to give me the R&D expenses for the last 5 years. See why I'm going to do that? When I think of R&D as a capital expense, what logically follows? When you treat something as a capital expense, what do you have to do in the following years? You have to amortize or depreciate, right? So if you told me there's a 5-year life for R&D, I have to go back and look at the R&D expenses from 5 years ago because you've written off 1/5 every year and you're going to write off the last 1/5 this year. R&D from 4 years ago, 1/5 every year. I'm going to see what's left over. Each year's R&D expense, I'm going to keep track of two numbers. How much did you write off this year, and what's left of that investment from that year? Rather than talk in abstractions, here's an example. I took Cisco. I gave them a 5-year life, somewhere between Microsoft and the pharmaceutical business, a little longer period for payback. I collected the R&D expenses every year for the last 5 years. And I also got the R&D expense from the current year. Here's something about the current year. It's kind of a confusing concept, but in valuation, whenever we talk about the current year, we're talking about the year that's just ended right now. So that current year's expense has just been spent, like 1 second ago. So I'm not going to amortize it yet because you've just invested that money. So the 1.02 billion you invested yesterday or 1 minute ago is still there. The 745 million that you spent 5 years ago, I'm going to write off 1/5 each year, and there's the last 1/5 being written off. Now there's nothing left over, but I wrote off 1/5 this year. R&D expense from 4 years ago, I wrote off 1/5 this year. There's 1/5 left over. R&D from 3 years ago, I wrote off 1/5 this year, 2/5 left over. See, each year's expense, I'm keeping track of what I'm writing off, which is always 1/5 of that expense, and I'm keeping track of what's left over. If I add up that second to last column, I come up with 2.9 billion. That is the R&D expense from previous years that I haven't written off yet. I'm going to call that, for lack of a better word, the value of my research asset. It's now going to show up on my balance sheet as an asset, which means something's got to change on the other side of the balance sheet, right? Either debt or equity. Where am I going to add the 2.9 billion? Why equity? You're right, it's equity. Because it came out of earnings, right? The R&D expense was covered with equity earnings, so that 2.9 billion is now going to get added back to equity. So equity is going to go up by 2.9 billion. My asset is going to show up as 2.9 billion. This particular year, if I add up the last column, 903 million is what I'd have amortized this year if R&D had been treated as a capital expense all the way through. So let's think again of the consequences for operating income. Cisco reported operating income of whatever number, but the 1.02 billion would have been the R&D expenses that they subtracted out this year to get to operating income. I'm going to add it back saying you should never have subtracted out, but I'm going to subtract out the amortization saying that's like depreciation, which means my operating income for Cisco is going to increase by 117 million because of this adjustment. So here are the effects you're going to see. My book equity is going to increase by 2.9 billion. You're going to see a research asset of 2.9 billion. Your operating income is going to increase by 117 million. In fact, I'm going to take a company and take it through just like I did the gap so you can see the consequences at each stage. Okay? This is SAP, German technology company, fairly large R&D expenses. Okay? Did I do it? I'm sorry, this is SAP. No, this is Cisco. It should be SAP right from the beginning. Okay? So let's take SAP and work through the numbers all the way through. Their stated operating income was 2.025 billion. Because of the adjustment I made, I'm going to increase that by 117 million. So because I'm treating R&D as a capex, I've increased their operating income. Here's a small thing it's a small mechanical detail, but you got to kind of keep it in play. The way we treat R&D right now does give companies a tax advantage. Do you see why it's a tax advantage? Because right now the way the tax law works is you get to deduct the entire 1.02 billion no matter what I think about this. Even if I decide to capitalize it, you're still deducting the entire amount. So you actually get a tax benefit from the entire R&D expense, not just from the depreciation. Because of that tax benefit, it turns out that my after-tax operating income also increases by 117 million. I mean, you say, why isn't it 117 times 1 minus the tax rate? It's because of the tax benefit. So it's actually a very convenient thing. If I ask you how much does operating income increase by, it's 117 million. How much does after-tax operating income increase by? It also increases by 117 million because of that tax benefit you get from R&D. Yep.
So just to make clear, so when you add the 117 to the EBIT,
Yep.
you go down to after taxes, you don't pay taxes on those 117.
Exactly. It turns out that the extra amount that you're claiming as normally if you'd been the accountant right from the beginning, the tax laws were based on this, you'd be paying taxes on a larger operating income, but because the tax law gives you that benefit, it turns out that your after-tax operating income and your pre-tax operating income increase by exactly the same 117 million.
Just to finish up the question,
Correct.
so your net income and your balance sheet, your P&L and your balance sheet, you're going to have an accounting one for the taxes, because the taxes are always going to be based on accounting. And the second
Exactly.
cash flow.
Exactly. Exactly. And your treatment. Because your taxes are going to be based on what this is not true just for R&D. It's true for everything, right? You always have to have two sets of books. And in a sense, that set of books will reflect the tax laws. This will reflect your views of R&D as a capex. Okay. So now we have 117 million more in after-tax operating income. On the balance sheet, my book equity is going to be increased by 2.9 billion. That's the value of my research asset. Capex. If you look at Cisco's traditional statement of cash flows, it looks like they have no capex. 2 million, almost zero, which is incongruous with what Cisco looked like in '99, which is, I'm sorry, I keep going back to Cisco. Now, what SAP looked like in terms of as a growth company, saying, how can SAP have no capex? Well, the reason for that is they're treating the biggest capex that SAP has, which is R&D, as an operating expense. So when I treat R&D as a capex, my net capex goes from 2 to 119 million. So let's summarize. Your after-tax operating income increases by 117 million. Your net capex increases by 117 million. Your free cash flow to the firm doesn't change, right? And it shouldn't. You wrote the check out. Whether you write it out to R&D or whether you write it out to capitalize R&D, you've spent the money. You're saying, why do we even bother? If the free cash flow to the firm is the same, whether I capitalize R&D or not, why go through this headache, this process of converting R&D to capex? And here's why. See the return on capital at SAP? With the original accounting, it looked like they made almost 30% return on capital because their biggest asset is off the books. When I capitalize R&D, the return on capital goes from 30% down to 20%, which is a much cleaner view of what SAP is actually making on its investments. I'm willing to make a statement that 80% of technology companies, what you see reported as ROE and return on capital, overstates the true return on equity and true return on capital because their biggest asset is off the books. The reason we capitalize R&D is to put R&D on the same level as every other capex and ask of it the same questions that you would have traditional capex. Are you making more than your cost of capital? So when I first started talking about capitalizing R&D, the complaint I got from accountants was, you're giving these companies credit for something that they haven't put into play yet. In fact, what's a conventional accounting argument against capitalizing R&D? What's the rationale for expensing it? It's too uncertain. I wish it were writing off. In tax purposes, their argument is it's too uncertain, therefore we're going to expense it, which is a stupid reason. It's a stupid reason because if you define uncertainty as a dividing line between capex and operating expense, if I'm a manufacturing company and I build a factory to produce a product that has a very uncertain market, will you let me expense the factory? You don't let me do that with any other investment. It's only with R&D that you selectively draw on this, it's uncertain, we can't let you capitalize it. And I'm not doing the company any favors by converting R&D into a capital expense. It is true I'm increasing their income, but I'm also increasing the book equity. I'm probably lowering the return on equity and return on capital. And here's my final defense. If I want to compare the PE ratio for Microsoft to the PE ratio for GE, right now I can't do it, right? Think of why. Right now, the earnings for GE is after only operating expenses and before capital expenses. The earnings for Microsoft is both after operating and capital expenses. The two numbers are not comparable. If I am an investor and I have to make choices between companies, I want consistency about the way we approach these companies, and right now we're not being consistent. That's not the
Aren't we in essence though not adjusting the tax rates by these changes that are making?
I'm not adjusting the cash taxes paid because ultimately it all comes down to cash flow. So I'm adjusting the taxes paid to reflect what you're actually paying. So the tax rate might be adjusted, but I don't care about the tax rate, right? Because ultimately what I care about is what's my cash flow. And as long as I reflect what you actually pay in taxes, what you wrote as a check, then it doesn't really matter what rate you end up with as an effective tax rate because you've captured what the company actually is paying out. Okay? I'll tell you another thing. As long as we let R&D be an operating expense, we're inviting technology companies to play games with earnings, right? Do you see why? Let's say a technology company wants to beat an earnings estimate. There's an analyst estimate out there, $2.53. And you want to beat that estimate. There's 4 weeks left in the quarter. Half your R&D expenses have been loaded up in these last 4 weeks. Do you see what an easy way to beat the earnings estimate is? What are you going to do? Cut back on R&D? There, you've beaten it. How do you think Microsoft has beaten analyst estimates of earnings 55 out of the last 56 quarters? This is not coincidence. Technology firms routinely play this game of using R&D as a discretionary variable to beat or meet analyst expectations. And we let them play the game. So again, focus on why we do this. We don't do this to get a better estimate of cash flows. The cash flow estimate is going to be exactly the same whether you capitalize R&D or not. We do this to get a better sense of how much has this company invested and what is it making on its investments. Because if you cannot answer that question, you cannot value the company. So technology companies, pharmaceutical companies, oil companies, consulting companies. Where do I throw consulting companies into that? What's the biggest asset for a consulting firm? Human capital, right? What's the equivalent of CapEx for a consulting firm? How do you build up your human capital? Recruiting, training. What do we do with recruiting and training expenses right now? We expense them. Your biggest CapEx is off the books. You try valuing a consulting firm. If you cannot capitalize that expense, you're going to be sitting there saying, how do I know whether they're investing in future growth? Because right now we don't have a dividing line between CapEx and operating expenses. So again, like leases, this is a much bigger story of inconsistency. Because let's face it, accounting as we know it was designed for the old-time manufacturing firm, right? You bought land, you built a building, you made a factory, you produced products. Accounting works fine. You deviate from that. You become a service company, a technology company, a human capital company. You can already see accounting start to break down. Because it's still trying to say, where's the factory? You know factory, then no CapEx. So if you're valuing a service company, do not trust that CapEx number in your statement of cash flows, because what you're getting is a small sliver of the true CapEx in this company. Step back and see if you can do what I did with R&D with that company. It might not be feasible. They might not give you enough information, but factor that in somewhere into your analysis, because it is going to throw off your analysis. Any questions? So that's the second issue, is adjusting for leases, adjusting for R&D. Let's talk about one-time charges, non-recurring charges, unusual expenses, extraordinary expenses. Over the last 15 years, one of the things I've noticed increasingly with U.S. companies, and increasingly also outside the U.S., is companies are becoming more and more adept at taking these one-time charges, operating losses, extraordinary charges. In fact, it got so bad in the UK for a while that that analysts coined this term called EBBS for companies, and it's not what you think. It's earnings before bad stuff. Because this is what the company would say. Our earnings before bad stuff this year was $7 billion, and by the way, there was a lot of bad stuff this year. And year after year, you'd get this. Here's my point with one-time. If you have a one-time expense, and it's happened only once, I can live with it, right? That it's an extraordinary charge. But if you look at the last 10 years, take a look at Xerox. They've had 8 one-time charges over the last 10 years. And what the heck do you call that? An 8-time charge? At which point you're saying, are they playing games with operating expenses where they're lumping things up and taking them as extraordinary charges to make it look like they're making money? So use common sense here. There's no one solution that's going to work. Look at your company, see if there's an extraordinary charge, and go back in time, see how often they have extraordinary charges, because therein might be a clue to what to do about these extraordinary charges. Let's take an example. Let's suppose you're valuing a firm. It's reporting a $500 million loss after a one-time charge of $1 billion. If this were truly a one-time charge, in valuing this company, what are you going to use as operating income? Use $500 million as profit, move on. Don't make life difficult for yourself. Because if it's truly a one-time charge, it's already happened, right? You care about the future. The charge has happened. No point worrying about it. But here's a trickier question. What if you look back over time and you notice a $1 billion charge once every 5 years? Like clockwork, every 5th year you see a $1 billion charge. Yeah? This might be pure coincidence, but then strikes me that they're taking a $200 million expense that they have every year, lumping them up and taking them as a $1 billion charge, right? So here's my practical question for you. If you see that pattern, $1 billion every year, every 5 years that you see across time, and you've reported a loss of $500 million, if you're coming up with the earnings to use for this company, rather than add the entire $1 billion back, how much are you going to add back? You're going to add $800 million back, right? Because $200 million of that was the regular expense. $800 million is the lumped up expense of the previous 4 years, which means your adjusted operating income will be minus 500 plus 800, which will give you $300 million. So there's no one solution that's going to work on your company. Look across time, look at the history of the company, see if these charges show up repeatedly, because if they do, there's a clue there that you might want to use in adjusting for them. Yes, Luis?
No, I was just going to say that it's important to look at the cash flows of the company.
And also, is it a real charge? Is it an accounting? That's true too, because a lot of charges are accounting charges. They're not cash charges. You're basically writing book value to something like an amortization of goodwill. So first make sure that it, but assuming it's if it's just a pure cosmetic amount, then you don't care about it. But if it's a real charge and you see this showing up at regular intervals, bring it into the analysis. Don't ignore it just because you didn't have it that year.
$1 billion every 5 years, it's better to, in your valuation stuff, for every 5
What's
years,
the point?
you look at
It doesn't make it doesn't change your value as a firm. Your job is, you're not in the cash. You're not running this for the company and saying what are your cash requirements. You're just valuing the company. So unless it's going to make a significant difference in your overall valuation, smooth it out. Right? Especially if you have numbers that are changing over time, you want to make it proportional. You get so much more flexibility smoothing things out rather than try to predict which. Because you know what's going to happen. You're going to put in year 5. What happens? What if it happens in year 4? Somebody's going to jump down your throat saying you got in the wrong year. So let's not even expose ourselves to that critique. Just put it in as a normalized expense, and you're trying to smooth it out across time. Any questions on one-time extraordinary? No. So the $1 billion really was $200 million every year for the last 5 years that they took as a $1 billion charge. That's so when I see $1 billion every 5th year, I'm saying, hey, your real operating expense should be $200 million a year. You're taking one big amount. So I'm replacing the $1 billion charge with a $200 million normalized charge that they should be taking every year. Okay? So that's my way of kind of dealing with that $1 billion not being an expense for 1 year, but an expense over 5 years. Okay, so it's accounting fraud. This is a big issue now, right? In fact, there's a whole area of accounting called forensic accounting, which some of you might be familiar with, which has kind of come up in the last 10 years in response to the Enrons, the Tycos, the Satyams, the world. I'll send you a couple of references on forensic accounting books. What these books do is they actually list out things you can look for, because no company is going to say, we're committing accounting fraud this year, and then go on to the financial statement. You always hear after the fact that there was fraud. So what forensic accounting tries to do is look for clues that will tell you when fraud is likely to be committed in a company. Okay? Things like a big difference between accrual earnings and cash earnings. You know what the difference is, right? In your income statement, you report a nice positive earnings. You go to the statement of cash flows, they have negative cash flows. In other words, one classic ploy that Sunbeam used this was to sell items on credit, record it as revenues, record the profit, so you're reporting a nice healthy profit, but when you go to the statement of cash flows, what gives you away? When you sell items on credit, that's going to be a cash drain on you, right? Your accounts receivable go up. Your cash flows are going to be negative even though your earnings are positive. Again, I'm not suggesting that this is always an indication of accounting fraud, but forensic accounting lists out things like that, things you can look for. So I've listed some items that I look for when I do valuation that trouble me when I see them. One is when I see income show up from unspecified places. The company says, even though you feel happy, 800 million, you're not even sure where that 800, Enron was a master at this. You looked at their statement, a billion would pop up, 800 million, 500 million, 300 million. Where did that come from? Why are you looking a gift horse in the mouth? I just gave you $1 billion, move on. Okay? But if you see income from unspecified sources, kind of dig. You see a lot of income from asset sales, and it's happening year after year, but the company doesn't seem to be shrinking. How do you sell assets and keep their revenues? How did that happen? Right? So look for that. Sudden changes in expense items, SG&A, kind of ballooning out, dropping back, because then they're using that then as a kind of parking place for expenses they couldn't put elsewhere. Okay? Frequent accounting restatements. You can check this on the SEC website. Look for a 10K. Then look to see whether the 10K has been restated, because every time you restate it, you got to go back to the SEC and make a new filing. So look at your company, look for the most recent 10K, and then check to see whether they've restated that 10K. There are some companies that seem to restate every single year, And the restatement always works against you. Something seems to happen between the filing in February and again the refiling in April. And big differences between tax income and reported income. One of the things that I find that make me very nervous is when I see effective tax rates kind of jumping around from 40% to 8% to 35% to 11%. There might be a legitimate reason for it, but a lot of that is coming from the fact that you're keeping two sets of books. You have some strange deferred tax asset floating around there, and I'm not sure what you're hiding back there. Let me add one final item. You see a big goodwill item? Be very, very careful. Goodwill is the place where people go to park all kinds of bad things. If you look at companies that have been involved in accounting scandals and accounting frauds, many of them were acquisitive companies, companies that grew through acquisitions, because you can go back in time. Tyco, classic example of a company that did all kinds of things in acquisitions, and you couldn't catch on because of all that accounting for goodwill hiding the stuff going on behind. None of these is a final indicator. Look for a set of clues, and if you're really suspicious, start digging. Okay? Some of you might have read about when Satya Mandana, one of the big issues was the cash balance never really existed. And there were actually a couple of analysts who noticed strange things happening with cash, like the cash did not seem to be sitting in an account earning interest. You had billions of dollars in cash, but it's kind of floating all over the world, not earning interest. So one of the analysts actually got up and said, if you have all these billions of dollars in cash, how come they're not sitting in an account earning interest? And the CFO gave this answer that made absolutely, you can go back and read it and say, absolutely no idea what he's talking about. He said, it takes us a long time to move the cash. What, do you physically go with a wheelbarrow or something? What is this? Wire the cash from the account, get it done with. But the reason they couldn't move the cash was there was no cash. This was all set up in a way to kind of promote the fraud. So sometimes all it might lead to are new questions, and you might not be able to do much in a valuation exercise, but as an investor, you know what that tells you, right? If you have big unresolved questions, don't buy the stock, no matter how cheap it looks on a discounted cash flow basis. You have too many unanswered questions in valuing this company. Okay. Any questions on accounting fraud? Which brings me to the final issue relating to earnings, right? How many of you are doing negative earnings companies? Who's doing the negative earnings companies? At least one person in each group should be, right? And those of you who don't think you are will be doing negative earnings companies before this is all said and done. So don't sit back thinking, thank God I picked a nice positive earnings. By March or April, I guarantee you half this class is going to be working with negative earnings companies. Okay? Walmart, okay. Unless you pick Walmart. Everybody pick Walmart, you're going to be okay, right? So here's the framework I'm going to give you if you have a negative earnings company. When you have a negative earnings company, start off with a very basic question. Why is my company losing money? Sounds like a ridiculously stupid question to ask, right? Because your expenses exceed your revenues, you have losses. That's not the answer I want for this question. I want you to dig deeper. There is a reason your company is losing money. Try to find what that reason is, because the way you deal with negative earnings will be different depending on why the earnings are negative. Let's take the easiest scenario. Your company had negative earnings last year because there was a big strike. Boeing, for instance, every year that they have a strike, which is every 5 years when the labor contract comes up, we report a loss. Because what happens, they shut the plant down for like 45 days, and when they shut the plant down, it's a very expensive process. So they come out and say, last year we lost money, and they actually help you out. They say, these would have been the earnings without the strike. This is the cost because of the strike, and these are. That's the easiest scenario to deal with, because if it's truly a temporary problem, it's behind you, right? What's the easiest way to adjust for it then? Act like there was no strike, look at the earnings before the strike, move on. Pray and hope that your negative earnings company has a temporary problem, but I wouldn't hold out too much hope this particular year that that's a problem. If you have a cyclical company, this year, steel company, aluminum company, chemical company, you're probably going to lose money. Why? Because the economy is in a recession. You could be a very good cyclical company, but you're still going to lose money. Toyota is going to lose money this year, even though it's the best of the automobile companies. But if the only reason for your losses is the cyclicality. Notice I said Toyota, not GM. Right? Toyota's problems are purely cyclical. GM's problems are far deeper. If your problem is only the cycle, here's a simple solution. Cycles go up, cycles go down. You have recessions, you have recoveries. Normalize the income. In other words, look at the income for a Toyota across a cycle, which doesn't mean going back to 2007 earnings, because that'll be too high. It might be looking at earnings between 2003 and 2007, or 1999 and 2007. bring in a cycle, look at what they made as a margin during the cycle, and look at what earnings they have this year with those margins. In other words, what you're doing is you're saying, look, as an analyst, you're saying, why not just forecast out the next cycle? You want to try that? Go ahead. You have a tough enough time figuring out where you are in a cycle at any point in time. You want to forecast out the rest of the cycle? It's one of the most hopeless exercises in valuation, is analysts who sit there saying, I'm going to forecast the next recovery, the next recession, the recovery after that, the recession after that. There's no way you could do that. I'll save you the time. Normalize the earnings, apply a reasonable growth rate to that normalized earnings, value the company, and then sit back and ask, well, how long will it be before I see normal earnings? And you can discount the value, but don't sit there trying to forecast ups and downs in the economy into your valuation, because it's only going to get you into trouble. So if you have a cyclical company and the only reason for losses is the cyclicality, you can normalize the income. So temporary problem in cyclicality, what you're going to do is replace the losses with a profit, a normalized profit, and move on. Now let's look at
The process of normalizing the earnings, then, is it looking at
there are three things you can look at. One is you can look at the history of the company, right? Second is you can look at the sector. If you have a company that is doing badly in a sector that's healthy, you can look at what the margins are for healthy companies. I have a valuation of Las Vegas Sands on my that I'll put up again. A company that's in significant trouble, but there are healthy casinos. You can actually see what they're making. You can apply the margins of healthy companies to your company's revenue and come up with a normalized income. So you can look at the history, you can look at sector averages, and you can use a meld of the two if you want to come up with it. But there's no one solution that's going to work for every company. It depends on your company, depends on whether it's grown over time, depends on the rest of the sector. But you got to kind of bring them all together in some kind of judgment on what. Same thing with commodity companies, right? You value an oil company today. You got to make a judgment on whether normalized oil price at $35 a barrel or $55 a barrel. Exxon right now, if you look at its market value, is being valued with a normalized oil price of about $48 a barrel. That's the oil price you would need to break even at today's market value of equity. So the question you would have to face looking at ExxonMobil is, do you think oil prices are going to go back to $80, in which case you'll buy ExxonMobil? Or they're going to drop to 25, in which case you might find ExxonMobil to be overvalued. So normalization will vary depending on the kind of company you value. Okay? Yes, Luis, and then goes.
Generally, then equity research analysts do not do that because, I mean, commodity stocks.
They do the cycle. The question was, we talked about what I didn't want you to do. So a lot of analysts get into this game of forecasting cycles. And it's a very dangerous game. Because we know what the history of forecasters of cycles is, right? They never get it right. So what you then get in your valuation are your views on cycles and how wrong you are on those views. So here's what I'm going to do. I'm going to use normalized prices. I'm going to value the company. Then I'm going to give you the valuation. If you want to take a point of view on the commodity cycle then, or the price cycle, or cyclicality, you can take that valuation and put in your views, right? So if you're an investor, you can say, well, I think the economy is going to bounce back much faster than everybody expects, so I'm going to take this normalized value of Toyota, it looks pretty cheap, and I'm going to add to that value. So it lets investors make their own judgments of cycles, because each of us has our own view of cycles, and we're all going to be wrong. Why should the analyst force his view of the cycle into the valuation and end up with this joint effect of what he thinks about the economic cycle or the commodity price cycle and the value of the company? Okay? I mean, my challenge to analysts is, I would wager that if I asked them to even forecast 3 months out what the cycle is going to look like, they're going to get it wrong. And here they are forecasting 5 years of cycles.
My point is that they even almost overshoot that effect.
Absolutely.
Even a single day movement on oil prices
Absolutely.
may all
That's
come back.
exactly right. They're going. That's exactly right. So they're reacting to the underlying commodity price. See, what I want from you, if you're valuing ExxonMobil, is do you think ExxonMobil is a good company? What I think about oil prices can be separate. I can go to the person I trust on oil prices and ask, what do you think will happen to oil prices? But your job as an analyst is to value the company for me based on some normalized oil price. And then if you want to give me your views on oil prices separately, I'll take them. I'm not saying I'm going to ignore them. I'll take them, but they're two separate issues. And I'll make my judgment on which one I trust you on rather than meld the two together in the same valuation. Yes?
By normalizing the earnings, we are not pricing the risk of bankruptcy. Right now, for example,
That's
there
it,
are a lot of distressed companies.
That's a different issue. We'll come back to that because we're not doing that in any DCF valuation. The minute you show a terminal value in your valuation, what are you saying? Company is going to become a going concern and survive, right? It's an underlying problem with all discounted cash flow valuations. Now, what about a positive earnings company? Can a positive earnings company go bankrupt? So this is a general problem, right? It's not just specific to negative earnings companies. So we'll come back and address it because I agree with you. It's a huge underlying assumption.
I'm just saying that as an investor, you have to consider cash flow to be able to, take an investment decision. Otherwise,
Right, but we're still considering cash flows of a going concern. Now I'm saying there's no easy way to bring in distress into expected cash flows, but we will talk about bringing it in when we come up with the expected value for the company. It might be better to wait till the end to bring distress in as a factor rather than try to bring it into each cash flow, because it's going to create headaches along the way. If you try to say what is the chance of distress, what is the likelihood that I'll actually get this cash flow. Right? But that's generically true about all DCF valuations. Is we are we're optimistic. We act like the company will survive. Yeah. Right. You could. That's fine, because then you're not taking a point of view. That's perfect. Did everybody get his point? Which is, I said, don't take a point of view of oil prices into the valuation. His question is, can I use the futures price of oil and value the company? That's fine. That's a market price. Right? And in fact, that's an actionable price. You can actually go buy those futures or sell those futures. I have no problem with you doing that. Okay? So because that's not your view of the market, it's just the market's actual price. Okay? But if it's a storable commodity, you're going to see very quickly that, yeah, so in a sense, it's already gets built in. Yeah.
Together with Eddie's question, don't you look also if the company itself is already in the futures market and already locked in certain price?
That can affect the rev. So in a sense, it does.
So A, if they do that, you use their price. But B, if they don't do that, then I think that the idea of using futures might not work very well, because their policy is not to follow.
No, I don't think you need to be trapped by their policy. As an investor, all he's doing then is he's not saying they're going to sell at that futures price. He's saying the market's giving me an expected futures price. I'm going to value the company consistent with that expectation. Of course, the market expectation can be wrong, but if I think the market expectation is wrong, there's a much easier way for me to take advantage of it, right? I'd go to the oil futures market and take a position on oil. So by not bringing in a point of view outside the market into the valuation, it allows me to then again separate out what part of the valuation I trust and what part of the valuation I kind of want to act on. Okay? So your point is well taken, which is if a company already locks in the futures price, clearly the cash flows are already will reflect that futures price. But even if they don't, I will value the company as if the futures price is going to apply, and then ask the question: is that futures price right or wrong? And maybe make a investment decision based on that. Let's move to the other half of the picture. And these are the troublesome, and hopefully you're not going to end up with one of these companies, but my guess is some of you will. You could be losing money because of where you are in the life cycle. Very early in the life cycle, do companies lose money? Sure, right? You're investing, you're not. In fact, at an idea stage in the life cycle, a company is definitely going to lose money. There are no revenues, all you have are expenses. So sometimes you're going to lose money, not because you're an unhealthy company, but because of where you're in the life cycle. You could also be losing money because you borrowed too much. I gave you the example of Las Vegas Sands. Sheldon Adelson's company owes billions of dollars in debt from casinos. But Las Vegas Sands is a better example because it has a history of a healthy operating company. And in fact, its underlying operations don't look too bad. It still made, even in the last quarter of last year, it made money. It had a positive operating income. But it has so much debt that it could tip over. So the second reason you could be losing money is you have healthy operations but too much debt. And there's a third reason you could be losing money. You just have structural problems. GM. The economy could bounce back next year, but GM is still going to lose money. Why? It's producing the wrong type of cars. Factories are not updated. Workers might have legacy costs attached to them. You see why I've bundled these three together? Early in the life cycle, leverage, and structural problems. These problems are not going to go away quickly, right? The solution I gave you for the first two sets of companies, just replace the loss with a normalized income, will not work here. You cannot take GM and say, let me normalize the profit and assume a positive profit next year, because that's a pipe dream. It's not going to happen. In these companies, you actually have to dig the company out of the hole. In other words, you have to start with the loss, accept that as reality, also accept the fact that this company will probably lose money for the next 3, the next 5, the next 7 years. And if it does get healthy, it might take 8 or 9 or 10 years before you see the health show up as a positive margin, positive earnings. You, in a sense, have to coax the company from bad health to good health on your spreadsheet. And we will take a couple of companies like that. We'll take Las Vegas Sands. We'll take, Sears. We'll talk about how to kind of, push a company that's not healthy right now to health, but it's a much more difficult task than just replacing the loss with a profit and moving on. So when you have a money-losing company, kind of step back and ask, why am I losing money? What am I going to do to kind of fix this problem? Because you cannot value a company where losses continue forever. Or you can. It's going to have zero value for the equity. You have to figure out a way to kind of get around the problem. And you've got to come up with some creative solutions sometimes. But we'll come back and talk about the distress issue, because when you lose money, obviously the chance of distress increases across the board. Somewhere along the way, you've got to talk about distress. I'm not quite ready to do that now. But once we've talked about valuing a company, we'll talk about how to adjust that value for potential distress in this company. Okay? So that took us a while, but all we've nailed down so far is EBIT, right? Operating income, last year's number. Now, let's ask the second question. You got the operating income, you need to multiply by 1 minus the tax rate. Trivial, right? Tax rate. So here's my question. What tax rate should I use to come up with after-tax operating income? And let me give you the choices. You could use the effective tax rate. You've all done your accounting. The effective tax rate, at least in a very rough sense, is total taxes paid divided by total taxable income. It's like an average tax rate you paid across all your income. So that's your first choice. You could compute your own tax rate by taking the taxes paid and dividing by the operating income. That's going to give you a number lower than the effective tax rate because the operating income is before interest expenses. You could use the marginal tax rate of the country in which the company operates, which comes from the tax code. It has nothing to do with the company. You could use a weighted average marginal tax rate across the countries that the company operates in. You could say none of the above, but you better be willing to tell me what then, because none of the above is not exactly a solution, because you have to have a tax rate. Oh, this would be nice if it were true. Any of the above, as long as I stay consistent, same tax rate. You know why that can't be true? If that were true, what tax rate would we use in valuation? What's the easiest tax rate to work with? 0. So clearly it can't be true. But if it were, then all you'd have to do is be consistent, right? Just use 0 all the way through. So really it boils down to effective tax rate, marginal tax rate, or taxes paid divided by operating income. I'll give you a sense of the numbers. Last year, the marginal tax rate in the U.S. was between 37 to 40%. That's federal tax rate, state, local. The average effective tax rate across U.S. companies last year was about 27, 28%. And that's a pattern you'll see in Europe, you'll see in Asia. The marginal tax rate will be about 35, 40%. The effective tax rate is going to be about 7 or 8% lower. So here's my first question. Why is the effective tax rate lower than the marginal tax rate? It's not tax bracket, right? Because these companies are all so big that they hit the top tax bracket very quickly. It's because you have some really good tax lawyers, right? And what these tax lawyers do is they figure out ways to defer taxes. File that away. Because now let me ask you the question. Here you are doing a valuation. You're projecting income for the next 10 years. You're applying a tax rate to that income. In fact, you're doing a perpetuity beyond that. You have two choices. You can take the effective tax rate, 28%, and build it all the way through into forever. If you do that, what are you assuming about deferred taxes? So using 28% in year 1, year 2, year 3, year 4, year 5. So you're going to defer taxes. And then you keep deferring taxes through year 10 and forever, and it never catches up with you, right? If you believe you can pull it off, there's a federal prison cell waiting for you somewhere, ready to go. Right? Because if you defer taxes, no matter how clever your tax lawyers are, it's not a question of whether, it's a question of when. It will eventually catch up with you. You know when it's going to start catching up with you? It's when your revenue growth starts to taper off. In fact, if you look at the effective tax rates broken down by growth rate, the highest growth companies have effective tax rates of about 21%, much lower than the marginal tax rate. As the growth rate drops off from 25 to 20 to 15 to 10 to 5%, you see the effective tax rate start to climb towards the marginal tax rate. In fact, the lowest growth companies often have effective tax rates that exceed the marginal tax rate because they're paying deferred taxes from previous years and it's caught up with them finally. You say, how the hell would I know where my company is? Well, in your valuation, when does your growth rate start to taper off? You're projecting cash flows, right? You have a high growth phase. What happens at the end of the high growth phase? You put your firm into stable growth. But the growth rate is going to be 3%, 2%. Built into your valuation is a tapering off of growth, right? And if you believe what I just said about effective tax rates starting to climb towards your marginal tax rate as growth gets smaller, I've in a sense given you a solution, right? You can use the effective tax rate for the short term because I understand you defer tax, you have good tax lawyers. But as you move towards a terminal value computation, push your tax rate up towards the marginal tax rate. In other words, if you want to use 28% for the next 5 years or even the next 10, I can live with it, but don't lock in 28% as your tax rate forever, because if you do that, you're effectively assuming that you can defer taxes forever. It gets a little messier if you're in multiple locations with different tax rates, because at least in theory you should be taking a weighted average marginal tax rate. Las Vegas Sands, for instance, gets about 60% of its revenues in Las Vegas and 40% in Macau. And Macau, because it's tax-free, pushes down the marginal tax rate. Now here's the catch though. If at some point in time they want to repatriate that income back to the US and pay it as dividends, they will have to pay the differential tax rate. So a conservative valuation might say, hey, you know what? You get a 0% tax rate in Macau, but that's true as long as you leave the income in Macau. But if you want to eventually treat that income as income for the company, you have to pay a 40% tax rate. So if you're in multiple locations, don't get too carried away with that 0% tax rate location, because if that income ever comes back to the parent company, you will have to pay the differential tax at some point in time. Okay. Yep. Oh, you mean the cruise line companies? Well, first they claim their income is in the high seas. The marginal tax rate is nobody can tax us, so Carnival Cruise Lines, Royal Caribbean often have 1%, 2% taxes. So what makes them different is because it's not just that they're offshore, but their revenues are all kind of in never land. Okay? So it's
But they can repatriate the money without.
but where do they repatriate to? Where are they headquartered? Liberia, Panama. So they repatriate to a country. So usually that's why they choose to incorporate in a country with also zero tax rates. If they send their money back, it goes back to Liberia, where they don't get taxed anyway. They can pay, as a Liberian company, they pay the dividends. You pay taxes as an individual when you receive dividends from the company, but they don't pay taxes on the income before they pay you the dividends. So you will still pay taxes when the dividends get paid out, but the company as a whole doesn't have to pay taxes. Any questions on the tax rate? Okay. So think about that. Think about operating income. Think about tax rates, because when we start off on Monday, we're going to start off with a couple of other loose ends, and then we'll start with growth.